Stop what you're doing. Put the remote down. Tell your wife the dishes can wait. If you're heading to the bathroom, bring your phone with you and lock the door. Because what I'm about to expose is more important than whatever was about to distract you. Right now, this very moment, there is panic spreading across Wall Street trading floors. Not the kind you see on CNBC. Not the kind they admit to publicly. This is private panic. Whispered panic. The kind that shows up as phone calls. And that's what we need to talk about. For the last 48 hours, my inbox hasn't stopped. Messages from private wealth clients. From high net worth individuals in London and New York. Even from regular retail traders holding meaningful silver positions. Every email says the same thing. My broker called me. If you've been in markets long enough, you already know how unusual that is. Brokers do not call you to help you make money. They call you to sell you fee-heavy products, or to margin call you when things go wrong. They do not call you out of concern for your financial future. Yet this week, phones are ringing nonstop. Specific names keep coming up. Major firms. Identical scripts. Coordinated language. This is not coincidence. They are calling clients who held silver through the dark years. Clients who bought at $20, held through $30, and are now sitting on massive gains near $80. And suddenly, the message is urgent. The party is over. You need to get out. This market is about to collapse. But they don't stop there. They aren't just suggesting profit-taking that would be normal. They're pushing shorts, put options, inverse ETFs. They are actively telling their own clients to bet against one of the strongest silver bull markets in modern history. And listen carefully to the language they're using. They aren't saying volatility. They aren't saying pullback. They're saying meltdown. They're saying structural liquidity event. They're telling retirees and grandmothers that a guaranteed crash is coming in the next 72 hours. They are painting a picture of a violent flush that wipes out all of 2025's gains in a single afternoon. Now stop, step back, breathe, and ask the only question that matters in finance. Cui bono? Who benefits? Since when do bullion banks care about your downside risk? They didn't call you at $18 to tell you silver was the opportunity of a lifetime. They were silent. In fact, they were publishing reports saying it was going to $15. They didn't call you at $1.50. They didn't call you at $60. But now that silver is at $80. Vaults are draining and spreads are blowing out. Suddenly they're deeply concerned about your financial safety? No. This is not altruism. This is desperation. They are not calling to save you. They are calling to save themselves. Because for every seller, there must be a buyer. If they're telling everyone to sell, ask yourself who's planning to buy. The answer is simple. They are. They are trying to manufacture panic, selling to create liquidity. Liquidity they desperately need to escape their own positions. They are trapped in a burning building. And they are trying to convince you to run inside so they can climb over you on the way out. These institutions are likely short billions of ounces of a metal that is disappearing from the vaults. Every dollar higher costs them billions in margin stress. They are bleeding. And the only way to stop it is to scare you into folding your hand. To make you sell your winning lottery ticket so they can cover before the real explosion begins. And the weapon they're reusing, the boogeyman meant to terrify you, is something most people have never heard of. A dry, bureaucratic calendar event. They are pointing to it like a loaded gun. They call it the BCI rebalancing. They claim it will trigger a $6 billion dump the market cannot absorb. They say this is the catalyst that ends the bull run. But is it really a meltdown? Or is it the most sophisticated bear trap we've seen in decades? To expose the lie, we have to understand the kernel of truth hiding inside it, because the event is real. But the story they're telling you about it is not. And to dismantle this narrative, we need to understand the machine they're using to scare you. We need to talk about the Bloomberg Commodity Index. Let's talk about the weapon they're holding up to scare you. The Bloomberg Commodity Index, the BCI. To most people, it sounds like boring financial jargon. Just another ticker crawling across CNBC. But the big money, this thing, is scripture. Sovereign wealth funds, state pensions, university endowments. They don't pick commodities. They allocate through the BCI. This index is the grandfather of commodity investing. A massive passive machine controlling roughly $18 billion in capital. And here's the key point. This money doesn't think. It doesn't analyze fundamentals. It doesn't care about mine supply or solar demand. It follows rules. Blind, mechanical, relentless. And once a year, every January, it rebalances. This is not speculation. This is not sentiment. It is code. The index looks at its basket oil, wheat, copper, gold, silver, and forces each component back to its target weight. And yes, for 2026, silver's target weight was reduced from roughly 4.49% down to 3.94%. This is the document brokers are waving in your face. Look, they say, the robot must sell. The biggest whale is dumping silver. But that framing is deceptive. The robot isn't selling because silver is weak. It's selling because silver was too strong. The index has caps. No single commodity is allowed to dominate the basket. And silver didn't just outperform in 2025. It exploded. It doubled. Then doubled again. While other commodities stagnated, silver ran. So by December 2025, silver wasn't sitting at 4.5% of the index anymore. It had ballooned. Its effective weight had swelled to nearly 9% of total assets. Now pause here, because this is where almost everyone gets the math wrong. Social media says, relax. It's only a 0.5% adjustment. That's $600 million. That is rookie math. That's first-grade subtraction. The robot doesn't sell 0.5%. It sells the difference between what silver became and what it's allowed to be. From approximately 9% down to 3.94%. That's a 5% cut of the entire fund. Take 5% of $18 billion. You get $5.40 to $6 billion in mandatory selling. That's not a nothing burger. That's a Leviathan. At current prices, that represents roughly 70 to 78 million ounces of silver. Nearly 10% of annual global mine production, forced to market in a short window. This is why the brokers sound confident. The volume is real. They have the spreadsheet. But here's the lie. They want you to believe this selling is about to happen, that it's all hitting now, that it's a surprise. It isn't, because markets don't work that way. Ask yourself one question. If you knew months in advance that a massive index would be forced to sell billions of dollars of silver in January, would you wait until January? Or would you act immediately? The answer is obvious. The moment the new target weights were published back in October 2025, the smart money moved. Hedge funds, active managers, banks, they began selling into strength. November, December, quietly, methodically. They used the rally itself to hide their exit. That's front-running. That's how professionals trade indices. By the time we reached January, most of the selling was already done. That's why silver stalled near $80 instead of running straight to $100 in December. The market was already digesting the $6 billion. So what's left now? Only the true passive funds, the robots that are legally forbidden from trading early. And those funds? They're small, 2 or 3 billion at most. The tail, not the dog. Which means this so-called crash is a rear-view mirror event. The brokers know this. So why are they calling now? Because they want you to mistake the final mechanical selling for the beginning of the end. They want you to sell the bottom. They want your liquidity. They want to buy back what they sold higher using your fear. And just when you think this paper shuffle matters, there's a force in the East that doesn't care about Bloomberg, calendars, or algorithms. A buyer that doesn't trade paper. A buyer that trades ships. We need to talk about the China shield. While Wall Street is panicking over spreadsheets and rebalancing dates, something far more important is happening outside their control. There is a buyer who doesn't use algorithms. A buyer who doesn't care about Bloomberg. A buyer who trades physical metal. China. Right now, the most important number in silver is not the price on your screen. It's the spread. Silver in Shanghai is trading $7 or more above COMEX. That means the moment metal leaves New York, it becomes more valuable. That is pure arbitrage. Buy in the West, ship east. Repeat until the vaults are empty. Now look at what the BCI rebalancing actually does. It forces paper selling in New York. Price dips. Fear spreads. But Shanghai doesn't flinch. Every dip widens the spread and turns silver into a clearance sale for the largest industrial buyer on earth. This is the China shield. You cannot crash a market when the biggest buyer is standing underneath it with an open checkbook. China controls most of global solar manufacturing. Silver is not optional for them. When Western funds are forced to sell because a rulebook tells them to, China buys without hesitation. And the banks know this. That's why they're calling you. They are short billions of ounces they don't have. They need your metal now so they don't have to buy it later at much higher prices. So here's the final instruction. When that phone rings, hang up. Do not debate. Do not hedge. Do not sell. The forced selling window is almost over. The robot is nearly done, and when it ends, the price doesn't just recover. It snaps. This is not a meltdown. It's a bear trap. And it's a transfer of wealth from the fearful to the disciplined. Be disciplined. Hold the line.